Good morning, folks. How are you? If you would, just give me a heads up. The audio's okay. Let's try this again. Good morning. Let me know if you can hear me okay on X. All right, folks. How the devil are you? Happy non-farm payroll Wednesday. So that's a little bit of a different thing, isn't it? Listen to this guy interrupting all the time. All right, so we have a little bit of a curveball here today. But volatility usually comes by way of employment data. Generally doesn't come on a Wednesday, but the fine representatives of our U.S. government are hard at work, sowing chaos, and we'll save that for the next space, won't we? All right. So today we're just a few minutes, about 3 minutes or so, away from the opening bell, and what I have here on the chart or charts on the left-hand side, this is the electronic trading hours on a 1 minute chart, micro contract. Okay, so all of you cats out there that want to look for clout and all that, you can look at the big daddy here and see that I'm not trying to showcase the mini because I want to try to instill some measure of responsibility on your part. The volatility is just too high for you to be risking a whole lot. So this is obviously just for commentary's sake. It's not meant for you to take anything as a trade. Read the disclaimer in the description box below this video, as always. But the upper right-hand corner is the 5-second chart on electronic trading hours. Middle one is the 15-second chart. And the lower right is the regular trading hours time frame. So we'll watch and see where the opening is here so that you'll see the visual representation of the gap populate on the chart here. And as always, I'm not on TikTok. There's a whole bunch of scammers out there pretending to be me. They're actually trying to sell you my mentorship that's on my YouTube channel for free. Suckers. Anyway, the point is, I'm not on Instagram. I'm not on TikTok. I'm not on Discord. And unless I'm talking to you directly from my X account on Twitter, X, whatever you want to call it, or if I'm talking to you from this YouTube channel, you're probably not talking to me. All righty, about a minute left. I just want to pay attention to the opening before I get into somewhat of a review yesterday and teach a little bit this morning. Um, Admittedly, I'm not feeling too well. I'm a bit of a migraine. They had me on prednisone drops for my eyes, and they're giving me migraines. So you can see we went back up into that regular trading hours opening range gap, which is what you'll see populate here in a moment. On this chart here where it opens, that difference between that and this price right here, right there, that is the regular trading hours opening range gap for the folks that are confused by what that is. It's regular trading hours, not what the guy said was, or what he thought it was. We were in X space yesterday. All right, 2 seconds. Okay, see that? That's the opening range gap. So we open up with a premium gap. They've already taken minor sell side. There's a sell side liquidity pool here that's just outside the range of last Wednesday's regular trading hours opening range gap. Okay, and whenever we have the opening range gap here, you want to pull up your Fibonacci, previous regular trading hour settlement to opening. Now, I already know some of you are saying, please show me your fibs right there. Okay, take a screenshot of that. When this is half gap, that's the usual 70% chance of trading back to that within the first 30 minutes of trading. We'll see if that's actually going to occur this morning. That price comes in at 326 3/4. There. Now, I'm showing you these little time frames in concert with the 1 minute to the left to kind of like give you a small sampling of what I'm monitoring when I'm away from just a laptop. If I'm up in my office and I'm looking at all the monitors that I use when I'm really trying to go for it. If I'm casually just doing a lecture, if I'm casually just doing an execution to share with you on a general principle or theory, then I don't need all this. Okay. But for the, I guess, the sake of explaining to you how much I'm referring to in terms of extra time frames for precision, for support of an idea, the idea of smaller time frames, as I was teaching yesterday, and went into greater detail in the Follow X space with Kit and Company. They give you a little bit of an insight that would otherwise escape you if you're just simply looking at the 1 minute chart. And this orange shaded area here, that is last Wednesday's suspension block. And I'll take you out to the daily chart. I promise. Just let's just keep watching and see if we can get that mid gap delivery here. So far, we had a run on pre-session high here. We have a breaker there. Sort on my levels for the opening range gap manually. Just the last three numbers in the decimal. I'll kind of like reiterate why last Wednesday's regular trading hour levels, as I mentioned, to keep on your chart, why that was even salient the last couple days and today. Let's just watch and see if we can get the delivery on that half gap. See how nice it used the suspension block high, that orange box high here. And now we're exploring outside of that range of last week's regular trading hours opening range gap low. This blue line here, every one of these lines here, that's the opening range gap levels over here that we just did. With the longer all the way extended to the right, that is the gradient levels on the daily suspension block. And I'll cover all the pertinent details around that also, but I just want to watch the first few minutes of the opening range. In case you haven't noticed, this is what I teach you to do when you're brand new. You're not trying to push a demo account. You're not trying to pass up eval. You're not trying to prove you're smart to your ex-wife. just to just to clean the chart up a little bit because there's a lot of lines over here. I'm going to anchor just to the open of this candlestick. It may not actually agree with the level. It doesn't really. It's off by a quarter point. But I'll just anchor that there, and I'm going to remove gradient levels and this line here. Do that. So that's half gap for the opening range gap, regular trading hours opening range gap. And it's also a pool of liquidity resting here for sell side. Notice that. And it's also just below a gradient level on the suspension block on the daily chart that's shaded in this orange hue. Already, if you're brand new, this should already encourage you, even if it doesn't trade down there and hit that half gap or take that low out, it's already shown a willingness to want to move and travel after taking out the pre-session high. See that? And the breaker I mentioned here went up into that, hitting that, and then sold off a little bit. So does it afford you 20 handles? Sure it does. 15 handles? Sure it does. Okay. So in the beginning, while I guess it's important to kind of coach yourself to submit to an idea that it may go to a level that we teach as a usual draw, like half gap. It can 70% of the time trade to it by 10 o'clock in the morning. On a day like today, which I'm actively interested in, see if it'll still deliver or if they're going to get in here and monkey with it. The non-farm payroll Wednesday is a new vibe for me. So I'm trying to explore to see if it does, in fact, still yield to what I would normally expect it to do on any old given non-farm payroll. I don't think that anyone should be trying to trade ahead of the 8:30 employment data, whether it be on a normal Friday, like that's traditionally how it's done, or as we have it today. I think by waiting until the opening bell, that's a better approach to trying to mitigate unrealistic risk. Because I guess in a certain way, non-farm payroll has always been an exaggeration, and they know that there's a lot of lottery trading that goes around that event because it has a lot of volatility. But the volatility tends to be somewhat out of reach for some. If you try to use a limit order, chances are you're not getting filled. If you do a market order, you're not going to get the better entry that you're hoping for. You're going to get a lot of slippage. So it's just better not to do it at all until 9:30, and then watch and see, does the market give you reasons to justify participation? And if it doesn't, then it's okay. Just take a step back and just wait until the afternoon session. Now, as I mentioned moments ago, I said how we ran the pre-session highs here. So there was a little bit of minor buy side. They swept that, then traded lower, came back up, hit the bearish breaker, as I mentioned, and then traded down into this area here. All this price action, all of this in here, whenever you see something like this, you have to at least consider the imbalance above it. If you're trading from a higher level down into it, this inefficiency is always going to be the first consideration. So if you're tape reading it and you're watching it, you need to be cognizant of that because it may be a factor for either a reversal or, like we're seeing here, a pause and then consolidation. So while this is the technical draw by procedure, we're looking for the willingness to see the market trade back to the half gap. If it trades back to half gap, then the next thing is does it continue to go to three-quarter gap close or full gap close, or does it reject that half gap and start moving in the direction of the gap? Okay, so that's the gap and go. In this case here, because it's a non-farm payroll event on a day that's not normally delivered, I'm not in a rush to do anything. I'm more in a exploration mode. I want to see what is it doing, how is it behaving, because then that'll give me insight about either taking a lunch hour trade or a 10 o'clock silver bullet trade or a afternoon session or just simply not do anything at all today, which is always an option. And when prices are inside these little consolidations on the 1 minute chart, I'm not interested in looking at the lower time frame charts because they're not going to give me any information that's useful. I could care less about them. When we start moving and displacing, whether higher or lower on the 1 minute chart, then these charts are going to be useful. So I'm not staring at these charts trying to make rhyme or reason out of what price is doing until there's a reason to justify having done so over here on the 1 minute chart. So the 1 minute chart is parent, and the 15-second and 5-second are subordinate. So they're going to be a little bit, well, like children, they're going to be more active, hyperactive. Okay. And I want to focus my attention on the role of the parent time frame, which is the 1 minute. And then I want to look for unruliness in the lower time frames with gaps, inefficiencies remaining open, because then I have to parent them. I have to babysit them. Otherwise, I could care less what they're doing because they're in their little playroom doing what they do. Over here, I'm focusing on adult matters. Does price warrant my attention elsewhere? Consider how many times we've seen last Wednesday's regular trading hours opening range gap levels utilized. This morning, here, and now we're here. So buy sides resting right above here. Hmm. We're sitting right at the top of that suspension block from the daily chart here. So if this were bullish, let's play devil's advocate for a moment. Say it's a directional run. If it were, and if it was something that I would want to participate in, I would want to see this portion stay open and then go higher. but it's already showing a willingness to not want to do that here. So that's not constructive for continuation to the upside. Two levels of sell side in close proximity. That's right here now, and half gap with that sell side there. Notice to the left of that, there isn't any inefficiency at that low here. We have to travel all the way down to here before we would get to another inefficiency on the 1 minute chart. Now, the 1 minute has traveled outside and just above the daily suspension block. This is the suspension block right here. Can you see that? This candlestick here, February 3rd, is candle 1. Candle 2 is February 4th. There's a volume imbalance at the top. There's a volume imbalance at the low. And then candle number 3 is last Thursday's February 5th. And if you hit the set tab, see that? You don't get that lower volume imbalance. So that's why I toggle. I want to see where all the volume imbalances are. And if there's a setting option that when I toggle it, it gives me 2 of these on the same imbalance. I like to favor that one. And then you'll see the suspension block. If you have it toggled wrong, not necessarily wrong, but if you don't have it toggled like I have it here, you won't see that volume imbalance at the low. So you won't see what I'm referring to. I may create a form of confusion with my commentary because I'm referring to something that you in your charts don't see because the setting's not on the same setting I have. I always toggle back and forth when I'm looking at a daily chart. Okay, so that's how I taught it before. Every single time I mentioned it. Okay, so everything back the way it was. So right away, I can see that I'm thankful that I didn't participate this morning because of this. It's just it's a weird day to do what is not generally done, releasing employment data on a Wednesday. And it feels good to know that if you have a procedure that you're looking to follow, and then because there's a change, there's a disturbance in the normalcy of what data is coming into the marketplace, it, it warrants precaution. And unfortunately, in this day and age, there's so many young people that think they know everything because they watched a video or they went to somebody's seminar or they bought a course or whatever. They think they know everything and they know best. And they think that every day is a trading day. So therefore, every setup's a trading setup. And every day with data coming out, they should be ahead of the data and capture the move because they should be smart enough to do that. And people with common sense know that that's not true. That's gambling. And sitting still, getting more information is much more prudent, much more responsible because this is a game of keeping money first, not just making it. All right, so we're starting to see a little bit of movement on the 1 minute chart back and forth, perusing through the 5 second. We have a volume balance that just used that while we were in the other time frame. And we have that volume balance there. Relative equal lows here. So we have this is a potential draw. Still hovering around that regular trading hours opening range gap low from last Wednesday and a gradient level here on the suspension block, which I didn't mention to you when I had it on the daily chart, but That's what these horizontal lines are. I drop the fib on that from the highest high of the daily suspension block to its low, so that you can see all those levels here. The usefulness of those levels are, to me, I'm looking for and anticipating inefficiencies to form in close proximity to them. So that's why I tell you all the time that I know where my fair value gaps are going to form, and the high probability fair value gaps form in close proximity, and they're laying down some form of the fair value gap is touching it. Touching what? Touching one of the levels that is a gradient level. And that's how you know that I'm using that, or if I'm trading it, that I'm using that fair value gap, whether it be a target to support an idea around stop placement, a partial, an entry, something to that effect. So I'm not just going out there willy nilly, grabbing any old. Oh well, that's a fair value gap right there. That's what all the dollar menu mentors out there that look at my stuff and they think they understand it, and they talk about it in hindsight. And that's why sometimes I'll go into their comments and they'll say that that's not true, and then they'll delete my comment or make me invisible because I'm revealing their charade. Because if it's not doing these things I'm showing you here, it's not a valid fair value gap. There's lots of gaps that would look just by label only and by surface description, oh, that's a fair value gap. But not all fair value gaps are created equal. And when I see someone teaching or attempting to teach my stuff and they're saying, see, this is the fair value gap and blah, blah, blah. it- It's so easy for me to tell what they're doing is so hindsight cherry picked because they're not lining up with what a real fair value gap is. And it's over top, it's laying and touching a gradient level inside of a defined range. And since most of these cats out there don't know what they're doing, that's why they're always using the market replay. That's why they're always talking about things with the hypothetical position where they have the, I don't even know how to, I don't even about to attempt it, but where they drop the box over top of it and the little red area is the risk. And then the green box portion of it, that's the potential profit that's available. I don't do that stuff. You either know what you're doing or you don't. You shouldn't be charging people or attempting to teach somebody something you can't do yourself. So right away, this is a morning that is either high resistance or low resistance liquidity runs. That's a question for you to answer on X. Would you call this a high resistance liquidity run condition on the 1 minute chart or a low resistance liquidity run condition? The way you determine that is the candlestick you're in right now. Is it sharing the same space of the previous candle or candles? In this case, yes. What does that mean? What does it say? This candlestick here, it's inside the previous candlestick and it's inside of that previous candlestick. So in other words, you guys have come up with the term recently, barcoding. It's like a picket fence, just moving sideways is UPC symbol. Okay. What's a UPC symbol? Pick anything you bought at the store, pick it up, turn around and look for that little barcode. That's a UPC symbol. So this is high resistance liquidity run conditions. Can it go to targets as I showed in my trades in the afternoon yesterday? Sure, it can. It can do it. It's just very not. It's very challenging on the patience of a new trader. It's very challenging on my patience too, and I prefer not to do that. And also, if it's in an environment like we're all in right now, where it's this clown world right now, everything is so corrupt, corruption's rampant. It's more likely that it's going to be problematic for me, even though I know I can trade in high resistance liquidity run conditions because I have a little bit of skill behind what I'm doing and a little bit of experience. I I tend to not want to do it because there's better things for me to be doing. And I like sharing when I know the market's going to rip and go, doom, just go right to the target. So if you don't have the same skill set and you don't have the same measure of experience that I have, and that's not me being condescending to any of you, we're talking about a friendship, a mentorship. I'm reminding you that it's not realistic for you to expect you to be able to navigate very easily right now because the risks are so astronomical right now. The volatility is ridiculous. The moves are skittish. That means they'll start, they'll give up, they'll come back a little bit more than you'd be willing to sit in. You can't really rush to move your stop to break even like most of you want to do without getting stopped out. There we go. So there's half gap. We did it 2 minutes before, a little less than 2 minutes before 10 o'clock. So there's the delivery. So we had a directional intention to observe price action. Okay. I'm not championing anything. I didn't do a demo. I didn't do a live. I just simply said, watch this. In the beginning, this is all you're expected to do. Okay. Now, if this is the first time you watched it, you might look at this and say, wow, that was neat. It went where we thought it was going to go. That's exactly what you're supposed to feel. You're not supposed to feel like, oh no, I wish I would have shorted that and I could have passed my eval with that, or I could have got my little nudge to get to my payout that I'm just one trade away from. What you're doing there is you're associating observation and drill to speculation and profit seeking. And you can't do that when you don't know what you're doing. And a lot of you simply want me to come out here and do what I'm doing today and also talk about entries because you want to parrot in your accounts what I'm outlining in analysis on these live streams because you know enough about me that I'm not going to talk about something that I don't have confidence in seeing develop in real time. And that's the worst thing you could be doing here. You're not learning anything by doing that. You're learning codependence and you're not focusing on the things that I'm teaching. And you might say, well, I'll go back and watch the recording. It's not the same thing because you now have stimuli associated with the outcome of what we were observing. And you lose the effectiveness of the first presentation of what it feels like without any risk associated to it, no monetization, no needing to be right. None of those things are associated with it. And that's exactly how it's supposed to be for proper learning. All right, so now this is what you're supposed to do. Half gap, that was our model. That was one of the things I had for my son. All he has to do is look for that type of move. If we have a sizable gap opening, 100 handles or more is ideal because that means you got about 50 handles potential offered to you. Here we have the market trade above pre-session high. You're going to hear Scout snoring. She's behind me. So if you hear, just know that I'm not waking her up just to avoid your emotional outburst over it. Can you not let that dog do that? No, no, she's like a kid to me. She can do what she wants to do. All right, so this is buy side pre-session. And this is exactly what you would be doing. Up, left, make it a little bit bigger. Okay. So pre-session is anything prior to 9:30 opening bell. Okay. So here we have a run at 9:30. The opening price is right there. Okay. So that's always going to be a very sensitive price level. You can annotate that. And we'll make that black. Well, it's got to be black, bro. And that's actually on the wrong thing there. There, there. And then we'll do price, middle, right. Not so big on that one. Okay. And then now we can look at the element of first presentation. So here's 9:30, 9:31. Now we can anticipate any fair value gap from that point on, but it has to displace. It has to be moving in a direction where we anticipate price gravitating towards. This is the part you guys are getting mixed up. I'm watching some of you guys live stream, some of you are trying to teach. Okay. If we have a gap opening, okay, if there's a large gap opening to the upside, that means we're opening with a premium gap. That means that there's a 70% likelihood. Now, don't take my word because I said 70%. Go back through as far as you can on your own data and continuously keep that data going forward. Every single day, there's a gap. See if, in fact, these numbers hold up. I've been doing this for 34 years, and I use data that was 50 years before me. So you determine whether or not you have any trust in that data figure or not. It's not important for me to convince you. I'm content with the information. But you should not be taking my advice about anything. Go in and look and see if what I'm saying is true, because you'll get your own data, you'll get your own evidence. Okay, you don't need to adopt somebody else's opinion about me or my concepts. So here, what is the market doing here? It takes that low out here and it closes below it, and it's doing what? It's traversing lower. It's moving lower. There's protraction moving lower. So it's displacing lower away from what has just transpired, which is that run on that buy side that was pre-session. So the market trades up, knocks out that liquidity, trades down, takes out that candlestick's low. It's leaving that liquidity pool that just absorbed all these buy stops. It collected all that. Smart money is short here. Now you have a framework as I outlined. I didn't just say it today for the first time. If you've known anything about what I teach with opening range theory, it is the first 30 minutes of trading from 9:30 to 10 o'clock in the morning. I don't care who says otherwise. It's 30 minutes, folks. Okay, it's 30 minutes. Smart money is accumulating short positions with existing orders for people that want to buy at a high price. That's what their buy stops above this high is affording them, a protection on shorts. Or they want to buy on a breakout. They think if it goes here, it's going to break out and continuously move higher. So those buyers at a higher price from where we opened at 9:30 affords smart money the counterparty to handshake with, and they will sell to them. They will give the liquidity to this existing pending buy orders. Who's going to win that arm wrestling match? Smart money. So smart money gets short here. So where does smart money offset distribute their short positions? There's two places it does it. Discount inefficiencies. That means a fair value gap below this area here. So think about it like this. Okay, so smart money went short at this level right there. In their interpretation of navigating the markets, they want to look for levels that they can buy where other traders are willing to sell to them at a cheap price. So who wants to sell? Would you sell your house for $100,000 less than it's worth? But that's what retail does. Retail traders do that. Retail traders sell something at a discount price to professionals all day long, and smart money takes those discount prices gladly. How do we do that? How do we determine that? I outlined it this morning. I said that this level here was half gap and a sell side liquidity pool. So visually, this is what you should have in your chart. Don't use mine, okay? If you don't do your own annotations and mark up like I'm doing here, and we're gonna be done here in a couple minutes. So it's not like it's a lot of work. So you can replicate all this in your own charts. Just taking my screenshots or taking screenshots from my videos and saying that's good enough. It's not good enough, okay? But smart money sees this as an entry, and what they're doing is they're targeting that low as I outlined this morning live stream to you. So they're looking at this as an entry. That's their entry. And they are looking to capitalize and consume the sell stops that are resting right below that low right there. That's their first area of offset distribution. And I'll explain that in a second. Just give me a moment. Isn't this fun? Oh, you didn't take a trade. You're a fraud. Win a Robin's Cup, bro. So we have sell side liquidity here. Okay, so you as a classically trained retail trader, you're looking at where's the price pattern that I can use right now, and continuation patterns, flags, pennants, head and shoulders, you know, trend line support resistance, all those types of things. You're trying to use that flawed logic. And I'm telling you, and I've been telling people for 3 decades, this is what's actually happening. Smart money sees this as an entry, and then they target the traders that are long or went long down here. What's below? If they went long here, how they protect their long position with a sell stop. So by definition, when the market trades to that price, that sell stop becomes an order to sell at market. So it produces a flood of liquidity with the express purpose of pairing up people with the interest. They want to sell at a cheap price. This is a cheap price in relative terms to where this price was. So when I'm watching price action and when I'm reading price and when I'm teaching you to look at this dichotomy. It's how you are to interpret price action like smart money does. By having this mindset, it allows you to frame a context and say, okay, selling above the high here and targeting here, that is what? It's an implied dealing range. Anticipating a beginning of a run here and seeing it trade here for first stage offset distribution. That means partials, they can profit there, they can bank profit, and they provide liquidity at these price points too. So that's the reason why I say all the time that there's not any real necessity for you to be looking at depth of market, book maps, liquidity maps, all those things. All you have to do is know what time of the day you're trading. Look at what it's doing, and just look at where the old highs and lows are. There's a low right here. The same thing is happening. This area of entry to this, and another level would be here. So this, what is this level right there? That's the employment data. So anyone that was trading that, they're going to have orders resting below that. What kind of orders? Sell stops. So they could do another measure of sell stop liquidity, pairing that up with another second stage offset distribution, meaning what they sold short up here and they have left over after taking some of it off here, they can buy that back below that low right there. And it'll be like this. So when having levels in mind like this, when you're looking at price action and you're tape reading it, there's offset distribution right there. So there's two levels with liquidity. Okay, so it's smart money entry, first stage offset distribution. Smart money takes some of their winning position off, and then the second stage down here, and you see them take that there. Okay. Notice that this entire range, and I'm going to have to close it because it's getting too long. I have to keep the videos under an hour, or it won't allow the the AI translation. So I'm thankful that a lot of you are appreciating that. So the only way that can happen is I have to stay short, and I can't go on and on and on, which unfortunately, like the present YouTube doesn't allow that. I guess it's too much information for them to tax their servers with it, so they keep it to an hour maximum, which is fine, I guess. So this is the implied dealing range. meaning that, let's do an ugly yellow color. All right, there you go. Nice and ugly, but it stands out, right? So we have visually, you would interpret this as smart money going short at the high, okay, turtle soup, and then it trades lower. I told you that this would be your breaker, which is the down close candle between the high, the low, the higher high. This candlestick in here, that's your breaker, and there's your opening price as well. And then you have first presented fair value gap right there, right here. So by having this, it trades up into that, overshoots a little bit. You can color outside the lines, it's okay. And then the market sells off, and then we go into this high resistance liquidity run conditions where you got to just simply wait, just wait. And then the market starts to move lower, and then you can go into the lower time frames over here and look for inefficiencies in price action. Nice one right here. See that little gap right there? Trades to it here, sells off, uses the suspension block from the daily charts, gradient levels here, and then starts to explore lower prices. Once it gets down to this level here, it trades right back up into a gradient level once more there, and a fair value gap, and a consequent encroachment of this wick, which is half gap theory, same thing as the opening range gap. Trading to half gap, half range, half order block, okay, helps us define whether or not a market is bullish or bearish while a run is underway. Meaning, look at this little wick here. See that wick? If the price can't leave a body above that and it trades from here up into it, but it repels that, is that indicating that it's bullish or bearish? It's bearish. It's extremely heavy. So whenever I see a market that's bearish and it trades up into a wick like this, watch. If you're learning today and you like these kind of lectures, this is the time when you want to let me know with the like button. It doesn't make me any more money. Okay, I promise you, it doesn't make me any more money. And I'm going to take everything off here and just leave the half level for consequent encouragement. So that way you can see the level. Okay, so right there's the wick, and this is where it hits that perfectly. And that price is 342.50, and the high comes in at 342.75. So it's one tick off. So that's good enough for government work, right? So it acts just like an immediate rebalance, which is extremely powerful. It's immediate response. You get immediate feedback. In the next candle, you would see it open. You want to see it become aggressively weaker. And does it do it? Yes. Trades up in a small little gap here and breaks down lower and trades down to even more of the gradient levels on that suspension block. So I'm pleased to see how, even though that the economic data was manipulated and left to a day that it doesn't normally deliver it, it still gave up the ghost and moved as we would expect to see it do. So I hope you found this one insightful. I have to break it here because of the time. Otherwise, it doesn't afford me the luxury of having you guys with other languages and the barriers that come with it to be able to listen to these lectures in AI voice. So give me some feedback on X if you learned anything. If you didn't, just, I guess, go watch somebody else. Until I talk to you next time. Be safe.